Ladies and gentlemen, good day and welcome to the earnings conference call of Nexus Select Trust for Q2 FY24. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prateek Tantara, Head, Investor Relations and Strategy from Nexus Select Trust. Thank you, and over to you, Mr. Tantara.
Good evening, everyone, and thank you for joining this second quarter financial year 2024 earnings call of Nexus Select Trust. At this point, we would like to highlight that the management may make certain statements that may constitute forward-looking statements. Please be advised that our actual results may differ from these statements. Nexus Select Trust does not guarantee these statements or results and is not obliged to update them at any time. Specifically, any financial guidance and pro forma information that we will provide on this call are management estimates based on certain assumptions and have not been subject to any audit, review, or examination procedure. You are cautioned not to place undue reliance on such information, and there can be no assurance that we will be able to achieve the same. Joining me today are Lalit Sehgal, Executive Director and CEO, our CFO, Mr. Rajesh Deo, our COO, Jayan Naik, our Chief Leasing Officer, Mr. Nirzar Jain. We will start off with brief remarks on our business and financial performance and then open the floor for questions. Over to you, Lalit.
Thank you, Prateek. Good evening, everyone, and thank you for joining us. It's my pleasure to welcome you to the earnings update call for Q2 FY24 for Nexus Select Trust, India's first retail REIT. We continue to strengthen our leadership with great execution and strong performance across all our 17 malls located in 14 cities. I want to spend a couple of minutes on the macro before we get into the quarter's performance. As you know, India's organized retail growth is in its nascent stages with a long runway for growth on the back of a young population, growing middle class, and rapid pace of urbanization. To tap this growth, India remains on top of the radar of international brands with a total of 24 new international brands that have entered India since 2021. Some of these are Uniqlo, H&M, Home, Apple flagship stores that opened in Mumbai and Delhi, Popeyes, Tim Hortons, Peter Manager, and Paul. So lots of new brands that have come in across many cities. Coming to the quarter 2 performance of the Nexus Select Trust, I'm happy to report that we have witnessed very strong sales growth of 18% in this quarter, stable occupancy of 97%, and a 24% re-leasing spread on 150,000 square feet of re-leased area. Our share price since listing in May has appreciated 27%. The NAV of our portfolio, as per independent valuers, has also increased by 8% to 138, rupees 138 per unit. Nexus has been included in key global indices like the MSCI India Domestic Small Cap, FTSE EPRA, and the National Association of REITs. In line with our strategy of inorganic growth, we have executed a non-binding term sheet to acquire 3 high-quality malls in southern India, totaling up to 1 million square feet. These proposed acquisitions are subject, of course, to completion of ongoing due diligence, negotiations, execution of definitive agreements, and statutory approvals. We look to close this acquisition by early next calendar year. Now, let me take you through our performance in the quarter, which is in line with our projections, as mentioned in the IPO document. I will also touch upon our maiden distribution. Number 1, we closed the second quarter with retail sales of INR 29.6 billion, which, like I said earlier, is an 18% growth over last year. We added 4,511 million in terms of tenant sales, which is 450 crores, And just to put it in the context, this is equivalent to 1 quarter of tenant sales at Select City Walk or Elante. So basically, we have added 1 Elante or 1 Select City sales in a quarter, right? So that's really what is the delta that we have achieved in terms of tenant sales. In terms of categories that have done well, entertainment, jewelry, electronics, beauty, personal care, all of them have done much better than the average growth of the consumption. In Q2, footfalls have grown at 14%. This is important because whole of last year, FY23, while sales growth was very good, 22-23%, footfall growth had not happened. Now we are seeing for the first 2 quarters 12% and 14% growth in footfall. So that's a very good sign that people are now coming back in larger numbers. In our key markets, our tenant sales growth have been significantly ahead of the market. To just give you a few examples, in Mumbai, Bangalore, Chennai, and Pune, which are some of the key markets where we have comparable data, we have witnessed very strong double-digit growth versus the market, which is growing in mid to high single digits. At a consolidated level, our NOI stood at INR 3.9 billion, reflecting a 17% Y-on-Y NOI growth, which is clearly on track in terms of our projections as per the IPO document. We are pleased to announce our first distribution of INR 4.521 billion, translating to INR 2.98 per unit. That's rupees 2.98 per unit. That is our first distribution. As per the REIT regulations, as you're aware, we have to distribute 90% of our cash flows. However, we are distributing 100% of the cash flows. The period for which we are distributing this, please note, is from May 19, 2023, which is when the REIT got listed, to September 30th, 2023, which is the end of Q2. So that's the period for which the first distribution is being made. Let me now take you through some of the reasons for our strong performance. I think the first one, of course, is a strong retailer relationship. Over the last 7 years, we've built very deep relationships with close to 1,000 domestic and international brands through a key account management system. We opened 84 new stores across our malls in this quarter with brands like Predator Manager, Ethos, Decathlon, Hugo Boss, etc., to name a few. We constantly assess and work towards improving our retailer experience and take various measures to align them with our business goals. We conduct periodic retailer satisfaction surveys. This is an important one, to build stronger and more productive relationships with our partners and have consistently scored more than 90%. In fact, in this quarter, the Retailer Satisfaction Index, RSI, which we measure, at the end of September was upwards of 95%, which is significantly higher than even September last year. So that's a very positive news for us. Number 2, our strategy of leasing, repurposing, and rezoning. We spoke about this at the time of our listing as well. First, with strong demand from tenants, our leasing occupancy now stands at 97%, which is 120 bips higher than last year. Today, most of our malls have a healthy wait list of brands looking for space. We ensure timely opening of new stores, and our trading occupancy, which is the stores which are now trading, is up 380 basis points and stands at 95%. So 95% of our area is now operational and rent yielding. We have leased 200,000 square feet during the quarter across 214 deals, out of which 150,000 was on account of releasing. Our releasing spread stood at 24%. If you will recall, at the time of the IPO, we had said that about 10% of our leases come up for renewal every year, and the spread that we've got over the last 5-6 years is around 20%, and we hope to see that in the future as well. So we've achieved 24%, which is in fact ahead of what we had indicated. We have a stable lease expiry profile with about 0.7 million over the next 3.5 years, with 20% releasing spread, which is what we spoke about earlier. The next bit is about now having achieved a stabilized occupancy at 97%. There's not too much new leasing that will happen in terms of increasing from 97 to 99. The typically not something that happens. Maybe it may go up to 98. But what's important now is that with the kind of understanding we have of the demographic shopping behavior, we are actually looking to premiumize the brand mix of our malls. We are taking back area from underperforming stores, replacing them with growing categories like beauty. Beauty has grown very well, personal care, electronics, athleisure, fitness, F&B, and entertainment. Some of these categories have grown very, very significantly. In one of our Bangalore malls, just to give you an example, we have repurposed a very large anchor area and introduced categories like athleisure and kids entertainment, and this is contributing to not just higher footfalls but also higher tenant sales and releasing spreads. We've also rezoned some of our stores, which enables us to achieve better spreads in our rentals. One such example would be our mall in Chennai, where an entire sports and women's zone has been rezoned in line with the anchor offering on the floor. All this has given us 28% higher rentals in that same area. 3, our marketing and activation strategy. Our size and scale, now that we have a pan-India presence, in fact the only mall business that has a pan-India presence now, we have been able to sign Bollywood ambassadors, superstars like Amitabh Bachchan as our happiness ambassador. We have focused on category promotions like the Gloss Box, Tech Box, Denim Fest, etc. And as a result of this, across the portfolio, we have seen, like I said, a 14% increase in footfalls compared with last year. The other thing that is important to note is that technology is becoming very, very important in our business. We successfully tested what we call the Nexus 1 app for consumers at Nexus Ilante, Chandigarh, and after a successful run, we have now started extending the app to 5 more malls, and we are targeting to extend the app to 10 malls by March of 24. This will not only give us very, very rich consumer data, but will also help consumers in terms of both figuring out where the stores are, locations, etc., and we'll also have a very strong loyalty program on this. So technology as we go forward will be the backbone of our growth. Coming to part 2 of my speech, this is about the business model. As you are aware, our business model is very unique. We acquire assets that have been under-invested and or under-managed. With our capability to invest in upgrading the assets, bringing in relevant brands, investing in appropriate marketing, reducing costs, we are able to significantly enhance the value of the acquired assets, as you would have seen in this quarter and in the first half of the year. I'll give you just one example. Mangalore, a mall in Mangalore, which we acquired in the midst of COVID, was only 72% occupied when we acquired it. We have added 43 new brands to the mall, and today the occupancy is 87%, and the way it is going, I think we will very soon cross the 90% mark. And NOI has grown at a CAGR of 47% over the last 3 years. So not only has occupancy gone up, but the NOI also has grown at a CAGR of 47%. We've done this by improving the brand mix and leveraged our tenant relationships to bring in marquee brands like H&M, Time Zone, Forest Essential, KFC, Domino's, and Starbucks to a market like Mangalore. In fact, in our South India portfolio, comprising of 8 malls that were acquired in March of 21, occupancy has gone up from 88% at the time of acquisition to 95.4% currently, and their NOI is on track to grow by 18% in FY24. Tenant sales have grown at 19% year on year in Q2 FY24 in the South portfolio. So NOI growth of 18% in the South portfolio and 19% growth in terms of sale in the same 8 malls. Now coming to our balance sheet, we have a robust balance sheet, as you're aware, armed with a war chest of close to 1 billion for acquisitions on the back of a low LTV of 14%. Our in-place debt cost is 8.3% with dual AAA stable credit rating. So we have a war chest of 1 billion for acquisitions, which is at the heart of our business model. ESG continues to be an area of prime focus, and I take great pride in sharing that our GRESB score now stands at 86 out of 100, which is 10 points higher than what it was last year. Very proud of this achievement. We have commenced construction of a 3.3 megawatt wind power plant, which will meet 60% energy demand of a mall in Chennai. Not only would it lead to using green energy, the project would also yield 20% return on our investment. I'm also delighted to inform you about the launch that some of you may be aware of the Indian REIT Association in September 23, of which we are one of the founding members. The association has started working on key agenda items such as educating investors, improving liquidity of the REITs, and collaborating with regulators on enhancing the REIT governance and investor protection norms. We are confident that together with the IRA, we will continue to build understanding and awareness of the REIT product in India. Lastly, to summarize and conclude, one, we are witnessing very strong consumption demand across categories, as you saw, 18% growth. Leasing demand for our retail assets remains robust, both from international and domestic tenants, and at 97%, we are now almost fully leased. We'll be making our maiden distribution of close to 3 rupees INR per unit, and we remain on track to deliver full year projections, which we had made at the time of the IPO. Our strategy for inorganic portfolio growth is active with healthy acquisition pipeline, and we are close to, as I had mentioned earlier, to close our first acquisition. I thank you all for your continued support and belief in our path of growth and value creation. Thank you so much. And with this, we will now move to the Q&A. Please go ahead. I think Abhidev has a question from.
Robin, can we move to the Q&A, please?
Can you hear us?
Yes. Ladies and gentlemen, we will begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mohit Agrawal from IIFL Securities. Please go ahead.
Yeah, thanks, and great to see another strong quarter. So congratulations to your team. My first question is, for first and second quarter, we've seen 18% growth in consumption. We understand Q3 is a big quarter, so could you give some color on how October and November so far has been in terms of consumption?
Okay, I think fair question. Must remember, Mohit, that unlike last year, where in October we had both Dussehra and Diwali, this year in October we've only had Dussehra, and Diwali actually, and the start of the wedding season is in November. So we are looking at actually October and November as one period rather than, 2 separate months, because you know how consumption peaks during Diwali and the festival season. Will it be in line with the first half? we're hoping to see that. November started off very strongly. So yes, fingers crossed. I think we should see strong growth in this quarter as well.
Okay. Understood. So expecting similar for the second half also, right? For the entire second half. Similar growth for the entire second half also.
Second half, I don't know. I'm just saying that for quarter three, you asked what is it looking like currently. I think it is looking like a strong growth in the quarter. And quarter four, honestly, we'll have to wait and see how we end quarter three, and then probably we can take a better call on what quarter four will look like. But we are on course to meet our projections for the year. Whatever was the projection in the FOD, in the IPO, those projections we will meet for sure. Well, right now, as you know, we are ahead of the projection.
Understood. My second question is on the acquisition pipeline. You mentioned about 3 malls. If you could share any information around, the size. You have mentioned 1 million square feet. Any information that you can share, that will be helpful. Also, trying to understand that 3 malls, 1 million square feet. So what is the kind of size you are looking to target? Typically, what we were given to understand is that larger malls around 1 million square feet are the ones which are, which have a mix of multiplexes and, F&B and fashion, everything, So just trying to understand a thought process around that. What kind of trading densities or what kind of category mix are you targeting across these 3 mall acquisitions? Yeah.
Sure. Let me hand this over to Prateek.
Hey, hi, Mohit, Prateek here. So I think, Mohit, on the acquisition piece, we will not be able to share too many details at this stage. The only thing we like to kind of call out is that the acquisition is in line with our past transactions, wherein we've acquired malls that are not optimally leased and turned them around successfully. We are kind of okay taking or underwriting the leasing risk, which we've done successfully in the past, and we anticipate to do this year as well. I think on the acquisitions, like I said, it's still at a non-binding stage. Diligence is ongoing. We'll have approvals, etc., that need to be taken up before we can actually come back with something concrete around this. But we anticipate something around this to be given out early next calendar year. I think one thing that we can obviously say is that a lot of these acquisitions that we'll do will be accretive on a stabilized basis. So that's something that we are aware of, and we are kind of looking at minutely when we actually evaluate that.
So, Mohit, just to add to what Prateek has said, I think the point that you make is absolutely valid. We did mention, and we still, believe in the fact that there is a certain size and scale of what we should acquire. Equally, if you remember, part of our acquisition strategy is also to see where we can add value. And typically, we look at assets not just for size and scale, but also our ability to be able to ramp up both leasing and add to the NOI or the profits of that business. And that can happen only if the asset has been underinvested, or assets have been underinvested or not so well managed. So we look at both. So you're absolutely right. We look at size and scale, but we also look at the opportunity for adding substantial value to whatever we are acquiring.
And this would, I'm assuming this would be all fully leased out malls, like there would be no strata sales, or would you be open to looking at those malls also, and then you'll have to kind of, what is the strategy there?
So there's a difference, Mohit. One is it fully leased or is it sold? These are two different things.
No. I mean to say that if there is strata sale within the mall, even if it may not be fully...
No, we won't look at it because that is clearly not something that we would look at.
Okay. And one last question, if you could share what kind of consumption numbers has Select City done? You have given the consumption numbers. If you could share growth for second quarter and first half.
For consumption, 18% for us.
So just for the Delhi Select City mall.
Select, I think, has grown at 30%.
Upwards of 30%.
30% plus.
30% plus for the quarter.
And for the first half as well, yeah.
Okay. That's all from my side. Thanks a lot and wish you all a very happy Diwali.
Thank you, Mohit. To you too. Thanks.
Thank you. The next question is from the line of Murtuza Arsiwala from Kotak. Please go ahead.
Yeah. Hi, sir. There is a media article which talks about, the ruling about if electricity is being provided as a service and it's being clubbed with the rental, even the electricity charges would have a high GST rate of 18% applicable. Can you just clarify as to how the billing is done for the electricity and the maintenance services and whether this would have any impact?
Sure. Well, I'll pass this on to Rajesh to take this question.
Yeah. So just to clarify, our South malls, we do the electricity reimbursement along with GST, so we recover and deposit, so there's no exposure whatsoever from any angle. For the North malls, which are our first set of malls, we have always maintained a stand that electricity is outside the ambit of GST. Hence, any enactment or circular on GST will not impact. Point number 2 there is, you can also go on the principal-agent relationship which the current circular mentions. If you can demonstrate a pure agent-principal relationship, you can still be exempted from GST on pure reimbursement, which is electricity.
So, can't we have the same applicable in the South malls and therefore, the tenants would have that additional benefit?
Sorry, can you come again?
I'm saying the same rule which is applicable for the malls in North, can't we have that applied in South as well, where, so you lower the GST incidence for the tenants?
No, so what happens is for the South malls, because we have bought it from Prestige, and both these positions have been accepted in the code of laws, so we really don't want to change our stance in South, and because our safer position is always to recover and deposit the GST with the government. So we maintain status quo on both the set of malls till a clear guidance comes from the government.
And also, the fact is that it is a pass-through for most of the tenants in any case. So even where GST is being charged, it is something that is passed through. So they get a GST credit.
They get their credit. Sure. Okay. So it should not be a bother. Thank you.
No. Thank you.
Thank you.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good evening, sir, and congratulations on a good set of numbers. Sir, on the distribution per unit, so it is tracking around 8 rupees currently, of which I think 70% is tax-free as of now. So going forward, given how we have structured everything, what would be the guidance for the next year and on the overall distribution as well as the tax-free component of that?
Hey, hi, Sarvesh. Pratik here. Sarvesh, I think you would refrain from giving guidances at this point of time, but what we've projected in our offer document, we have the outlook to achieve that from a NDCF perspective. The salience is going to be about in that same zip code. 55-60% would remain dividends, about 30-35% would be interest, and the balance would be the amortization of debt.
Understood. But if you can give us some understanding about, when we talk about a very strong growth of, let's say, 18%, how does that sort of fall into our distribution per unit? One thing that I can think about is that in case you are acquiring something, then, maybe you will overspend in the initial years. But save that acquisition, ideally, most of it should increase the distribution significantly. Is that the right way to think about it?
There's correlation between, so like our leasing structure, there's correlation between consumption growth and revenue share. So as we cross certain thresholds, we get higher revenue share, which then results obviously flows down and results in higher distribution. So consumption growth is an important metric that we track, which results in better NOI for us, which therefore results in better NDCF.
And any acquisitions, like Pratik has said earlier, I think we do look at the fact that they have to be accretive. So it should actually help the NDCF.
In what percentage of your rentals that you are deriving as of now
Between
are
12 and
linked to
13%.
Sorry?
Between 12 and 13%. Revenue share, no?
Yeah, revenue share is 12 and 13% of the rentals that you are getting.
Absolutely.
Yeah, and remaining is sort of a fixed sort of a rental.
Fixed rental, correct.
And going forward also similar sort of a ratio is being planned, or you're looking at it differently?
No, I think 15% is optimal. Anything between 12 to 15%, I think, is where it rests. So I don't think, because it's also then becomes a bit of a risk if you have too much variable.
Understood. And finally, on the pipeline, so, I understand this issue of, you looking for underperforming malls and maybe basically trying to turn it around. But I guess if you also take into account some of these malls might be underperforming because of just bad locations. And if you take it out and then, they may not be sizable in terms of, they might be very small malls also, which in general don't perform well. So if you take out these two buckets, then you will have a very limited sort of growth opportunity in terms of these already being their pipeline, right? So then the other opportunity is to build it out, greenfield sort of a thing. So how do you look at these brownfield and greenfield opportunities? Because prima facie it looks like brownfield opportunities would be very few for you guys in the next, let's say, 5 to 7 years, and then you might have to just get into greenfield for growth.
So I think, Sarvesh, what I would say is that if the asset location doesn't make sense, that it's not infill or prime location for us, we wouldn't obviously evaluate it. Does that reduce or kind of minimize the funnel of assets that we have? The answer to that is no. There are about 100 grade A malls in the country which are in prime infill locations. The top 4-5 developers own about 40-45 of them. And there's a balanced 50-55 kind of asset, 50-55 mall assets that we've actually we actually keep evaluating. So there is a healthy pipeline. Obviously, to answer your question, if it doesn't make sense from a location perspective, we wouldn't even evaluate it. And coming to a second question on greenfield, etc. I think we are not averse to doing greenfield projects. At least if it kind of makes financial sense, we would definitely do it if it's in a prime infill location for us. Whether it's our strength is on the acquisition side, and that's what we are currently doubling down in terms of playing things. And we've created this whole 10 million square feet platform through acquisition. So I think the machinery is pretty well oiled from our side.
Understood, sir. All the best for the coming quarters.
Thank you.
Thank you. The next question is from the line of Adhidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, good evening, everyone. Thanks for the opportunity. The first question is on the NDCF walk down, just a clarification on the working capital adjustment. So this figure going forward, what is the nature of this adjustment in terms of what are the items? And going forward for the second half of the year, is this run rate going to sustain, or it may be higher or lower, either way, on the working capital front? Yeah, that's the first question. Hello, am I audible?
Sir, you are audible. Please go ahead.
Yeah. So, should I continue or wait for management, sir?
Members of the management, please confirm if you have got the question. Sir, you are not audible at the moment. Sir, there seems to be a problem with the line, with the connection. We're not able to hear you.
Is it better now?
Yes, we can hear you now, sir.
Okay. Adhidev, I've heard your question.
Yeah.
Okay. So I think this is mainly on account of the mid-month listing that happened on May 19th. I think the NDCF for the month of May was in a way impacted on account of this mid-month listing, and I will try and explain it through an example. Is about 95% of our collections actually happen in the first 10 days. That revenue for the period up to 19th or for the period 19th to 30th is also collected in advance and in the cash flow.
Sir, I'm very sorry to interrupt, but the line for you is gone bad again. We're not able to hear you clearly. Members of the management, we are not able to hear you.
Is this okay?
Yes, sir. Please go ahead.
Okay. Aditya, what was the last thing that you heard?
Yeah, you are explaining that it is the mid-month listing, some collections come in the first half of the month or something. So I think we are
come into the first half of the month, which means that revenue for the period 19th to 30th May was also collected in advance, and that's something that's released as part of this working capital adjustment. At the same time, there's interest payout, right? And interest is typically payable at the end of the month. Accordingly, interest for the period 1st to 19th of May also got paid post-listing. So this anomaly is there, and it was envisaged at the time of preparing our projections. I think we've just released this year to be in line with what we had projected at that point of time.
Okay, and so going for this number should trend lower in terms of the thing. Is the understanding correct? Because of these. Okay. So second question I had, so we have done the 18% consumption growth, and you mentioned that footfall growth has been 14%. So are we to understand correctly that 4% has been sort of inflation which we have seen, or is there any other way to read this number on consumption?
So the way to look at it is that there is a footfall growth and there is a growth in spend per footfall, SPF as we call it. There may not be a direct correlation, 14 plus 4 is 18, but it is a combination of footfall increase and SPF, spend per footfall increase. And yeah, I mean you could take 15 and 5 or you could take some ratio of 18. All of it may not be uniform. Some of it could be, for example, footfalls related to cinema, where the spend levels may be a little lower at times. So that's also possible. But our understanding roughly is that out of 18, we would say that about 6 to 8% would be the increase in spend per footfall.
Okay, per footfall and adjusted with this. Okay, sir. That's it from my side. Thanks. Yeah, thank you and all the best. Yes.
Yeah, thank you so much. Thanks. Yeah. Hope you heard.
Yeah. All loud. Yeah.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may please press star and 1. The next question is from the line of Satinder Singh Bedi from Eon Infotech Limited. Please go ahead.
Yeah, thanks for the opportunity. So a couple of questions. So there's been a slight increase in the valuations. Just wanted to understand, is it on account of higher revenue projections, or is there any change in the cap rate or the discount rates?
Of the IPO document remains the same, whether it is sales growth, market, or the VAT. This increase is basically rolling over from.
Excuse me, sir, we have lost your audio. Ladies and gentlemen, the line for the management seems to have disconnected. Please stay with us while we reconnect with the management. Ladies and gentlemen, we have reconnected with the management. Sir, you may go ahead.
Hey, Satinder, sorry we got disconnected. The line seems to be really bad. I'll let Rajesh answer the question.
Sorry, Satinder. Again, I repeat. So, like you said, all our basic assumption which was there in the IPO document remains the same, which is your WACC, exit cap rate, sales growth assumption, and the market rent assumption. What has taken up is the strong performance and the rollover to 11th year, which is around 750 crores. There was some capex commitment which has got done, so there's no future commitments. That is about 33 crores, and about the balance is on account of incremental margin from the other streams, which is like CAM, marketing, parking, and others. So that's a valuation increase of about 858 crores. Hope that answers your question.
Yeah, that does. Okay. What are the key risks that the management sees so far as, let's say, our most prime asset, which is Select City Walk, is concerned? So what are the key risks that you see? Okay, kind of, if any.
So as of now, the only risk and that's a macro risk, is what happens to demand over a period of time. I think right now demand is very, very robust, and like we said earlier, Select is one of our best performing assets with more than 30% growth in terms of sales. The Apple store there is doing extremely well. New stores like Adidas and Nike and all are doing very well. New F&B has got added. So overall, I think Select is in a very, very strong position from where we see it at a macro level. Nothing to do with Select. At a macro level, I think the risk, like in any other consumption business, could be some slowdown that could happen in the year ahead. It's possible, not that there are any signs of it as of now.
Okay, right. So, and in terms of so you've had a robust footfall growth, 14%, which would have significantly contributed to the strong top line growth that we've seen. This 14% might moderate going forward because this might be as a result of coming out of COVID. Okay, so how do you see the spends kind of panning out going forward? So a low double digit seems to be par for the course.
So first of all, I don't think we would speculate on future growth. All that I can say is that our first half performance is in line, or in fact a little ahead of the projections, and we are pretty confident that all that we have projected for FY24 we are on course to meet it. So that's all that I would say. I would not put a specific number on footfall increase, but as of today, from whatever we can see, I think the fact that people are coming out in larger numbers and with good set of movies coming in November, Diwali season, etc., I think footfall growth will still be robust.
Right, sir. One final question, sir, regarding Elante office. Okay, so Elante office seems to be subscale, while we understand it's part of the same complex. Okay, and to that extent, okay, it can get justified. But any plans of monetizing this, or you would continue, because it seems to be 0.1 million, seems to be subscale. Occupancy is not really top class. So what are the plans on that?
Yeah. So office, like you said earlier, is not our core business. Our business is retail. 90% of our business today is retail, and Elante office would account for a couple of percentage points. So it's neither here nor there. Not really of any great importance. And like you rightly said, it came as part of a much larger acquisition, which was the hotel and the mall, Elante Mall, and this came as part of that. Yeah. Okay.
Okay, but okay, yeah. Thank you, and congratulations. I think great set of results.
Thank you so much. Thanks.
Thank
you. Yeah.
Thank you. Participants who wish to ask questions may please press star and 1. Ladies and gentlemen, we have no further questions. On behalf of Nexus Select Trust, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.
Thank you so much.
Happy Diwali to everyone.
Happy Diwali.